therefore, my strategy is instead of going over that topic again. Actually, I want to teach you related topic in finance, which is value at risk. And by learning this topic, I want to teach you indirectly about the significance interval and hypothesis testing. Okay? Value at risk is very important topic in finance. And then value at risk is, could you please raise your hand if you have ever learned about value at risk? No one? Beg your pardon? In the graduate class, right? Okay. So besides the 2 graduate students, so no one knows about value at risk, right? No. Okay, anyway, it is very simple topic. Even it is so simple that I think even high school students can understand it very easily. So value at risk. So basically, value at risk is a concept to answer this important question. What loss level is such that we are X% confident that it will not exceed in n business day? Okay. Again, value at risk is answer to this question, basically X. And what loss level, actually it is loss level, so it is amount. So it is answer to this question. So what loss level is such that we are X% confident that it will not exceed in n business day. So value at risk is basically, whenever we say value at risk, basically we have to need another 2 values of these 2. I think the example, it is more clear if we look at the example. But first, actually value at risk is, there are better concepts than value at risk, which is called expected shortfall. Okay? So value at risk is the loss level that will not be exceeded with a specific probability. Okay? It is level of loss. But expected shortfall is more intuitive. It is called also C bar. C bar is the expected loss. Okay? It is not level, it is amount, expected loss, given that the loss is greater than value at risk level. So it is like expectation, conditional expectation. Conditional expectation such that, what is conditional expectation? Conditional on our loss is greater than certain level, and that certain level is called value at risk. Anyway, although expected shortfall is theoretically and more appealing and more intuitive, but it is value at risk that is used by regulators and practitioners in setting bank capital requirements. So, for example, every bank should have a certain amount of capital, 자기 자본, and that required amount of capital is determined by the value at risk of the company, like 3 times of value at risk, something like that. So what is the advantage of value at risk? It captures an important aspect of risk in a single number, and it is easy to understand, and it asks the simple question, how bad can things get? So there are many ways, but first, historical simulation to calculate one-day value at risk. It's like creating a database of the daily movement in all market variables, and the first simulation trial assumes that the percentage change in all market variables are as on the first day, and second simulation trial assumes that the percentage change in all market variables are as on the second day, and so on. We will examine the example of this case shortly. Again, the historical simulation on Thursday 11th September 2010, what happened is a massive sell-off of stock occurred. Suddenly, there arrived massive sell orders. The day was happened to be also the expiration date of the many option contracts. And then the huge selling started about 14:50 Korean time, which is just 10 minutes before the closing of the market. And then a group of unidentified foreign investors unloaded 1.6 trillion won, which is around 1.4 billion, of the stock through Deutsche Bank Group's Korean Securities Union, and causing a benchmark Kospi to drop 53.12 points, almost 3%, to 1914.73. So within just 10 minutes, Any question? What is your question? 그런 거 나중에 집에 가서 구글 검색을 하면 될 것 같습니다. 어쨌든, just 10 minutes, like 3%. Stock index dropped 3%. This, in nominal value, this wiped out like 30 trillion Korean won, which is approximately 27 billion USD in just 10 minutes. The size of the dumping sell-off accounted for like 1/3 of the total daily trading. Okay? From 9 to 3, we can count the total daily trading, and then within 10 minutes, 1/3 of the total trading happened that day. The rest of the market participants could not respond to the large order properly, okay? Because Deutsche Securities Korea made the order in the last 10 minutes, and now the system changed just because of this event. Like 3 years ago, okay, before market close, like 10 minutes ago, it was auction timing. So at the time during which all transactions were processed together at the final auction while ordinary trading was suspended. So at that time, the market closes at 3 o'clock, and then when we receive order between 2:50 and 3 o'clock, we don't press the order at the 10 minutes. We collect all the order together, and we settle the all order together at 3 o'clock. Actually 3:05 something like that, but approximately 3 o'clock we process that all order together in the last minute. Therefore, it was the previous system. Therefore, since this massive sell order occurs at the last 10 minutes, therefore, other market participants could not properly respond to this massive sell order. So stock price dropped. Stock index dropped like 3% in 10 minutes. Therefore, it is no wonder that regulatory agencies immediately suspected that, okay, there must be something going on. Okay, something going on over there. Okay, they suspected that foreign hedge funds has bombarded the market with sell orders. Speculative hands purchased the option contract right before the expiration date, and then unloaded their stock holdings to trigger the tumble of share price and make huge profit. More specifically, those investors must be holding option contracts that yield profit when stock price drop, hit the jackpot during the process. Okay. So more specifically, put option, right? Put option, if you have a put option and if stock prices drop, then you make money, right? So suppose you have power to control the market price, and if you have put option and you want to make stock price drop, right, in order to make money. actually that is possible if you have a huge order, if you can send a huge order. So you have put option, and just before option expiration day, okay, you send massive sell order, and stock price go down, and you make a lot of money. You put option. 네? 어차피 옵션 expiration date 하니까 상관없는 거죠. At the expiration date, there is no difference between American and European option. It doesn't matter. Actually, at the time, the put option was usually at the time because such option contract had become very cheap at the almost useless to buy because as the expiration approaches and as the cost seemed to have taken an upturn, therefore put option is usually seemingly useless. Anyway, figure 1 and table 1 illustrate how serious the option chart was. Let me open this window, another window. Okay, this is figure 1. So it was stock market was okay, and suddenly it was a big drop, right? And then new record created on November 11th, 2010, unit $1 billion. New record. So net selling by foreigners, 13,099 is a new record. Previous record was this one. And the net program selling, new record, and net program arbitrage selling again, like this. And KOSPI 200 trading volume was greater than before. So in any measure, it was a very massive order, and it was a very significant event in the stock market. By the way, 박남규 학생. The media at the time, newspapers and TV called this mini crash as the 11/11 option shock. Some even call the event as 11/11 option terror or option terrorism. And then one brokerage firm surveyed its employees and they find that 11/11 option shock as the most salient events of the year 2000. Okay. And then in this, okay, this is also a brief description about 11/11 option shock, and there are some major players involved in the event. First, it has been rumored in Yeouido that many financial institutions made great losses and had been collaborating in order to hide those losses. Nevertheless, 3 players stood up. The most significant player was actually WYU Asset Management. WYU Asset Management had traded option contract and had made profit for a while before this event, but suffered large losses before the market closing because of the option shock. So this firm was okay, but suddenly they made a huge loss at the option shock. Its loss mostly resulted from short position in strangle. Okay, I'll explain what is strangle shortly. The buyers of the strangle, sorry, I need a period here. Yes, strangle. The buyers of the put option contract asked YJS to sell at 499,000 won per contract, which is 10,000, 100,000 multiplied by closing price and strike price of KOSPI 200. And here, 100,000 denotes the contract size. And then because of this one, the liability rose to 89.9 billion Korean won. And then the YG Asset Management had broken the investing basically 73 times of their capital. Their capital is only 10 billion Korean won. Okay. And actually it is 7,300 times of their capital, and in regulation only firms can invest 5 times of the capital. Okay. So that's 73 times of their capital, which is much more than 500 limit specified by the law. Consequently, YG Asset was unable to pay out the liability. They sold the contract because, and then they have to pay money. But problem is that they couldn't. They didn't have enough capital. Their loss is 73 times of their capital, so it is impossible to honor the contract. Consequently, YGS was unable to pay out the liability. Instead, Hana Daetu Securities, which sold options on behalf of the YGS Management. Okay, so Hana Daetu Security was brokerage. They were providing brokerage service to YGS Management. So as a broker, actually they paid 76.3 billion Korean won to the investors, and then they have to receive money from now YGS Management, but YGS Management cannot give money to Hana Daetu. Okay. And of course, bad luck continued, which always happen. Okay. Bad things have to happen together. The information about the massive loss had quickly spread throughout the market and triggered a fund run. Fund run is similar to bank run. Bank run is people run to bank to withdraw their money. Fund run is people run to fund to withdraw their money from each fund. National Pension Service, 국민연금, and other investors in the various funds of the YGS Management ran to withdraw hundreds of billions of won from the fund. On November 26th, an employee embezzled 3.8 billion won. This series of events around the option shock severely damaged the reputation of the YG Asset, which is critical to asset management business. In response, YG Asset sued which Securities Korea about the option shock. Another player, Hana Daetu Securities. Okay. Hana Daetu Securities, which is a Korean brokerage firm, they lost 76 billion Korean won again. They shouldered this amount on behalf of the YGS Management, which turned out to be insolvent. YGS Management also declined. Actually, they also declined. They didn't have ability, and then they also declined paying Hana Daetu, arguing that the mutual fund, the YGS Management, was not obligated to compensate the loss of Hana Daetu Securities. The Hana Daetu conducted a due diligence. They actually inspected the YGS Management for the payment and the possible acquisition, and it also sued major shareholders of YGS Management and brought lawsuit against British Securities Korea on February 26, 2011, 서울지방법원, okay, Seoul Central Court. And then the KRX issued a warning to Hana Daetu about the failure of the risk management and the rate margin deposit on the derivative trade by YG Asset Management, and Hana Daetu had been required to receive 80 billion Korean won by one day before the event, but they didn't. Thus, if Hana Daetu had received the deposit as required, it would have much less problem at the option shop. But clearly, that 80 billion Korean won is again like more than 70 times of the capital of the YGS Management. So anyway, that was impossible. Last player, which is the series of trading orders 7 to 8 of trading orders from Deutsche Bank Securities made up most of the 1.6 trillion Korean won, 1.4 billion USD sell off at the option day, option shop. In addition to the trading, that was suspected manipulative, Deutsche Securities breaches KRX rule, 증권거래소 규정, which requires disclosing computer-driven trade by filing a report 1 minute late to the KRX. Okay, so it is kind of a minor. Okay, it is minor, but anyway, Korean regulators estimated that Deutsche Securities made 45 billion Korean won of unfair profit with the trading and suspected manipulation and the inside trading, such as buying put option. Okay, so it is exactly what I thought. Actually, maybe the better strategy is that if you can send a large sell order, and if you know people cannot properly respond, what you can do is first buy put option at a very cheap price, and suddenly send a massive order, stock price go down, and you exercise enough put option and make a long one. Clearly, it is illegal, but anyway. It is insider trading, such as buying put option before sending massive selling order. So that's what Korean regulators suspected. Now let's investigate this event further. Derivative positions of YGSM management. Do you have any question about now? Do you understand this event? Yes. 그런 일이, 그러니까 911 때도 알지 못하는 선물 매도 포지션이 대량으로 거래가 됐었다는 그런 일이 있었죠. 어쨌는지 모르겠지만 경보가 있었던 거지, 911. 풋옵션보다도 더 확실한 방법은 쇼 포지션을 취하는 거지. 그래서 911 때 실제로 그런 일이 있었다고 합니다. 그리고 여러분 믿거나 말거나 우리 연평도 포격 때 그때 주가 좀 떨어졌죠. 근데 연평도 포격 직전에 풀옵션과 숏 포지션이 많이 거래가 됐다고 합니다. 그러고 나서 북한이 하진 않았겠지만, 그러니까 금융 전문가들은 감이 있었던 거지. 뭔가 일어날 것 같다. 그리고 제가 요즘 그 박사과정에 파키스탄에서는 박사과정 파임이라고 박사과정 학생 하나랑 쓰고 있는 논문인데, 파키스탄에서도 그 테러리스트 이벤트가 어택이 일어나기 직전에 스탁 프라이스가 떨어지는 경우가 되게 많이 있었어요. 어쨌든 그런 거에 대한 금융시장이 뭔가 정보가 있는 거지. 왜 그런 정보가 있는지는 잘 모르겠어요. 그렇죠. 이런 거 아예 그런 걸 노리고 그런 걸 트레이딩 했는지, 아니면 금융시장이 뭘 알기 때문에 어쩐지 모르겠지만, 어쨌든 금융시장은 여러분이 아는 것보다 훨씬 더 예지력이 있다는 거죠. 증권 찌라시를 통해서 그런 것들이 많이 돌아다니는 이런 것들. 근데 또 진짜 고급 정보는 또 증권 찌라시로 안 돌아다닌다는 말들이 있어요. 그래서 증권 찌라시 보면 사실이잖아. 연예인 이런 거. 증권 찌라시 통해서 돌아다니는 연예인 스캔들 보면 다 사실이잖아. 그래서 금융시장에 그런 정보력을 무시하면 안 됩니다. 어쨌든 derivative positions of wide asset management. So apparently YGSM management was the biggest victim of the option shock. It sold strangle short strangle position with 200 KOSPI 200 index underlying asset. Okay, again, yes. So their position was short strangle position, and its underlying asset was KOSPI 200. I'll explain to you what is strangle. In a short strangle, which was the position of the YGSM management, an investor sells a put and call with the same expiration date but with a different exercise price. Okay. suppose this exercise price. Okay. What is the call option payoff at the maturity? At the maturity, call option payoff looks like this, right? So it is exercise price. So therefore, if stock price is greater than X1, they will exercise call option and make money by this amount. If stock price is less than X1, and they then exercise call option and make no profit. So basically, as you know, call option is a contract. It is a right to buy an asset at the exercise price. So therefore, if asset price is greater than X1, you can buy some valuable asset at a lower price. So therefore, you will exercise this right, and you get the profit. Okay. But it is also right. Therefore, if stock price is there less than the exercise price, you don't have no reason to buy cheap asset at the higher price. Right. So you don't exercise the option. Therefore, pair looks like this. And how about put option? Put option is right to buy, no, not buy, right to sell an asset at a specific price. If an asset, the price is higher than X2, it is expensive asset. So you have no reason to sell expensive asset at a low price. So you don't want to exercise the put option. If asset price is lower than X2, okay, then you can make money because now you can sell a cheap asset at a higher price, so you make money. Okay, so it's a call option and put option. Now, okay, in a short strangle, okay, we have a long strangle and short strangle. Long strangle is opposite of short strangle. In the short strangle, an investor sells a put and call together. Okay, so it is a long position of the call. Then what would be the short position of the call? Short position of the call would be looks like this, right? It is short position. So it is what happens if you have call option. This is what you will have if you sell call option. 아, 맞다. 아, 죄송합니다. 네. 그렇죠? 이렇게 되겠죠? 이렇게 되고, 네, X1. 그렇죠? So if asset price is greater than X1, the option holder will exercise asset. They will ask you to hand over an asset which is expensive at a low price at X1. Therefore, you have to sell an asset which is valuable, expensive at low price, so you will make a loss like this amount. Okay. If you have a short position in the put option, then you will have something like this. If asset price is greater than X1, put option holder doesn't exercise the option right, therefore nothing happens. But if an asset price is lower than X2, now put option one holder sell cheap asset at a higher price, and then therefore you have to accept that order. You have obligation to honor the contract. Therefore, you have to buy cheap asset at higher price of X1. So this is a short position of the call option. This is a short position. Okay. Short position of the put option. Next, what if we combine short and both short position of call and put? Okay, and issue that if we combine this and this, then suppose X1 is greater than X2, then we have right, something like this, X2, X1, right? If you sell both of them, and if you now, so it is okay, it is pure payoff of having short position of the call and put. But suppose you or perhaps some cash, which is maybe because of premium of the selling those two, then what your in the end your position would be looks like this. So this is plus maybe some cash. Okay. So it is profit. Okay, it is a pay up and pay up. So I mean, if you sell call and put option, you receive some money, right? And then the distance is what you have received by selling and put and call. So basically, this is called short strangle. Long strangle is looks like this. Long strangle is having the position, long position of both put and call. So in short strangle, this strategy offers limited profit but with unlimited downside. So let's investigate. Okay, let's look at this example again. This is actually case 1 should be. Okay. So but anyway, the maximum profit we can obtain this strangle is this amount, right? This is the maximum profit we can obtain. And then how about loss? Loss is unlimited. So if you have short position, you have again limited profit, okay, but unlimited loss. A trader would believe short strangle useful if she expects little volatility in the underlying asset near term. So you can guess who wants to have this short position, short strangle position. You would want to have this position if stock price is somewhere between these two, right? Which means that you believe stock price don't move too much, okay? Don't get volatile much. So if it is in the narrow band, you make money. And when stock price goes either very up or very down, you will lose money. So short strangle is basically it is your betting, okay? Betting against volatility. It is your betting that market will be stable in future. Does it make sense? Short strangle position. This is called short strangle position. Okay. Short strangle is combination of short position in put and call. So it is again short position. If you sell both call and put together, and both they have different exercise price. So it is a short strangle called a short strangle. Long strangle is opposite. It is called a short strangle because it is a combination of two short positions, put and call. And again, this short position is your betting against the volatility. If you believe market is not extreme in the future, okay, market there is no like crazy event in the future. If you believe that, you wanna invest that kind of product. 할 수 있으면 그렇게 해야지. 할 수 있으면. 그렇죠? 재빨리. 예. 그래서 스탁 프라이스가 많이 움직일 것 같은 중간에 그럼 재빨리 이 포지션을 바꾸든지 처분하든지 해야죠. 그러고 싶겠지, 사람들이. 많은 사람들이. 하지만 여기서 같이 10분 동안 갑자기 3%가 하락해 보이면 10분 동안 손쓸 수가 없는 경우도 생깁니다. So let's continue. This type of strangle strategy has been very popular among institutions in 여의도. Figure 2 describes the short position of actual wise asset management conducted. Conducted, not conducted. Of. Okay. This is wise asset management. So what they did is that they sold put option of the 180,000 contract with exercise price of 252.5. Okay, And they also sell, okay? They sell call option by 70,000 contracts, exercise price 257.5. And contract size is they deliver to 100,000 of index. Okay? So therefore, this is the exercise price of the put option part. This is the exercise price of the call option part. Okay? Therefore, at that time, okay, yes. So their maximum possible profit was $1.8 billion. And if they this YGSMA must have made money if the stock price is somewhere here, actually. So right before the event, okay, where is the previous graph? Okay, stock price was between 254 and 5, right? Stock price is highest point was 256.1, so 44, 45. And stock price was somewhere here, okay? So YGSM management was very happy at that time because they were somewhere here, okay? They was about to make $1 billion, and so in 10 minutes, stock price becomes this point. 문은 닫고 가야 될 거 아니야. Okay. Now, okay. Now, since stock price is 2.7547.51, wow. So therefore, their loss is $88.8 billion. Okay. It becomes their loss. Okay. So you understand what is going on? Okay. This is simple, right? There's no difficulty, nothing serious about this. Yes. Maybe the price is different. I mean, no, not price different, but I don't know. It is their particular strategy, and if they have a different amount of contracts, then maybe it changes slope each side. Okay, and it doesn't matter. But anyway, yeah, maybe the price was different, so maybe they have a different price and something like this, so maybe they want to have a balance. So this is the position of YSM management. So this is what happened. So suddenly from here, stock price goes to here. So heaven and hell suddenly. Figure 2 describes the short triangle of YSM management. The firm called this product as a dark horse fund. Okay? They call this one as dark horse fund. This dark horse fund had a very simple structure, as I explained. It sold 180 contracts of the put option at the exercise price of the 252.5. And they also sold 70,000 contracts of the call option exercise price of 257.5. Each contract denotes 100 units of KOSPI 200 index. Therefore, as far as KOSPI 200 remained stable between 252.5 and 257.5, the fund could have made 1.8 billion Korean won. However, its loss could explode if KOSPI 200 moved far beyond the range. And then, unfortunately for large assets, this is exactly what happened during the option shock. On September 11th, no, not September 11th, 11/11/2010, the KOSPI 200 dropped from 254.86 opening price to 247.51 closing price, and therefore the fund lost 89 billion Korean won. And the fund broke the law by betting more than illegally allowed, as I said. Korean regulators computed the risk of adjusted values of the option contract as the number of contract KOSPI 200 index plus 100,000. Therefore, the fund could invest only 62 billion Korean won, 5 times of its asset value. But instead of it instead it invested 4.5 trillion Korean won, which is around 73 times. We'll take a photo. So this trade by YG asset management resulted in large ramifications. Several local securities houses, notably Hana Debt Securities, suffered a huge loss as the dark horse fund was unable to pay back the payoff of the short strangle. YG asset management and its top managers fell under the scrutiny from both market and regulatory agencies. On the other hand, international investors who purchased the contract won windfall. Okay, not purchases. Let's change it. Who long the thread one windfall as KOSPI 200 promised. Okay? Because they made this loss, so someone must have made this amount of money, which is international investors. Okay? Hit the jackpot. Okay? Some of them were presumed to hit the jackpot. Anyway, after the joint investigation, Korean Regulators and Exchange, Financial Service Commission (FSC), 금융감독위원회, okay, and Final Supervisory Services, 금융감독원, 금감원, 금융위, 금감원, and Korea Exchange, 증권거래소, argued that Deutsche Bank violated the provision on market manipulated by exploring the relationship between spot and future market using KOSPI 200 stocks and derivative trading. FSC's press release described their investigation result. Appendix 1 summarizes the argument of the FSC. If you are interested, you can read it. Anyway, the Korean regulators also notified suspect and misconduct to the Security and Futures Commission of Hong Kong (SFC) and Hong Kong Monetary Authority and U.S. Securities and Exchange Commission and Federal Financial Supervisory Authority of the German (BaFin). In particular, the FSC asked the BaFin to help identify the owner of the account in question and any illegal activities in the trading. Okay? Such requests were made through a formal channel of International Organization of Securities Commission (IOSCO). Further penalties on Deutsche Securities Korea would follow. KRX will not take any action on profit Deutsche made. Prosecutor may deal with it, however. Both spokesman Won Yong-jun told Reuters. Anyway, in a statement of the February 25, 2010, Deutsche Securities Korea said in a statement, Deutsche Securities Korea deeply regret the KRX action, however, respect its decision to impose such penalties. Okay? Let's go to the more numerical investigation of this example. Okay? First, we can do value at risk analysis we learned, and we can do value at risk analysis and stress testing. Okay, suppose, okay, assume that you are a risk manager in YG asset management and monitor the strangle position illustrated in the text, like figure 2. Okay, now let's assume that you are risk manager in YG asset management, something like this, and you know you have this position. And then suppose you are at the date of November 10th of November, one day before the option shop. Okay, conduct the following 3 analyses using the data about KOSPI 200 from 10-year data. Okay. 2011 to 2010 11-10. Students can download the data on one of the following links. So you can go to directly to KRX, or actually I kindly have the data. Something like this. Okay, is it data? Cosby 200 data from year 2010 to 10-year data, 10-year daily data. Oh, from 2011, 13 to 2010. Okay, so it is data and it is a Cosby 200 index. Something like that. And then first, we wanna do 1 day and 10 days. Suppose we are interested in 1 day and 10 day value risk about 95% and 99% analysis using the Monte Carlo simulation method. And second, we want to conduct 1 day and 10 day value risk analysis using a historical simulation analysis. And third, we want to conduct stress test. Okay. First, since we learned historical simulation analysis, so let's do this one first, second, because we just learned what is the historical simulation approach. And let's go to the PPT slide and let's read the definition of value risk. Value risk is the loss level such that we are X% confident. Here in our problem, it is either 95% or 99%. It will not exceed N business day, and we invest for 1 day and 10 days. Okay. 1 day and 10 days. Okay. And then in order to do the analysis, actually, okay. So this is the question 1. 잠깐만. 이거 똑같은 건가? 똑같은 거구나. So actually, I developed the R code. Okay, conduct 1 day and actually, instructed and answers. Okay, let's do the second one first. So conduct 1 day and 10 day value risk analysis using the historical simulation analysis. So let us conduct the historical simulation analysis with 10-year data. 10-year data is again in the Excel file. In the following sequence, this is what you do. First, multiply daily returns realizing for the last 10 years to the Cosby 200 value at November 10. This generates simulated index value, okay, and November 11 based on historically realized return for the past 10 years. Okay. Now let's think about what is the actual return. So here, let me save. So in this case, return is between this ratio between this and this, right? So day of 1 day before, okay, 1 day before the option shop, the daily return was like a 12%, right? This 12%. So from November 9 to November 10, so during the 1 day, stock price of not 12%, it is too large, 1.2%, okay? It was 1.2%. Okay, if you are not interested, I think the better one is maybe, let's slightly change it, and let's use log, okay? Okay, if we use continuous return, it is like 12%, 1.2%. Let's change it to percent, and then I want to increase number of decimals. Okay. 1.21%. So I generate this. So in this day, yesterday, stock price went up 1.2%. 1 day, a day before yesterday, stock price went up 13%, something like that. So it is the history of daily return. History of daily return for the last 10 years. Okay, I have to delete this one. Okay, so what we are doing is that we can regard each of these as a possible simulation. Okay, in the past 10 years, daily return was something like this. Something like this. So what we can think about is anything that happened last 10 years may happen again tomorrow, right? So it is all daily return. So it is reasonable, right? We can think that if something happened the last 10 years, it can repeat. Something similar can happen again tomorrow, right? So in this case, okay, simulated, we can generate a simulated, okay, cost P, okay, which is, okay, simulated cost P is that since cost P price is something like that, okay, so if yesterday's scenario happened again, okay, then what would be the price of cost P 200 yes tomorrow, which is should be this one multiplied by, now since we took low, so exponential of this one, right? So let me reduce. Okay. So what happened yesterday happened again tomorrow. Tomorrow's stock price should be 258.227, right? It should be. And if what happened one day before, the day before yesterday happened again tomorrow, then stock price would be, okay, now it is, since today's closing price is 255, it can happen again, so with exponential of this one, right? Okay, this is the second scenario. Since today's closing price was 255, and given today's closing price, if first scenario happens, our stock price would be 258. If second scenario happens, we can simply multiply this and this, okay, this and this, and then stock price cost P value should be 255. Okay? Let me highlight this special value. Okay, so this is our standard. Okay, so again, it is a historical returns, and each historical return is a possibility. This historical return can happen to today's closing price. Right? So in that sense, if you can keep do this analysis, so for example, this one, right? Okay, this is basically this one multiplied by exponential of this one, which is like what would happen if scenario of November 3rd, okay, November 3rd, 2010 happen again tomorrow, right? Then if this scenario happens to this closing price, then tomorrow's stock price should be 255, right? And this is all positive. Well, how about this negative? Okay. October 27th, year 2010, stock price went down 1.72% from yesterday. And if that drops again tomorrow, our stock price should be this one multiplied by this one, which is 253, right? Any question? Yes? 그거지, 하루하루인 거지. 그래서 10년치를 다 한 거지, 지금. 네. 이거 곱하기 쭉 이것만 하면 되니까. 어렵지 않죠? 네, 그래서 지금 이렇게 10년 동안의 결과에서 이게 하나하나 시뮬레이션을 다 한 거잖아요, 지금. This is all simulated value of tomorrow's cost P based on past 10 years scenarios. 아니, not yet. Okay, wait. Okay, so it is all possible values of cost P 200 tomorrow, right? And for each possible value of cost P 200, what we can do is we can calculate our profit in the short triangle position, right? So actually I made the R code. Okay, I think we can go to the R code. Where is R code? Question 2. Okay, R code to solve this problem is available here.